This week, foreclosures are spiking in these states and cities. What does this mean for home values and for future reverse mortgage applicants?
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Unemployment, foreclosures, and interest rates ultimately impact reverse mortgage lending. The point of today's episode is not to dwell on the negative, but to take an honest and hard look at the economic factors that can no longer be ignored amid a housing market and economy that frankly feels surreal. Presently, home prices remain frozen near their record highs despite mortgage rates doubling in 2.5 years, with a few notable exceptions. Also, the U.S. GDP continues to show robust economic output, despite our national debt reaching unsustainable levels. What gives, and how are the potential impacts on reverse mortgage lending going to be seen? First, let's examine the housing market. Home sales have plummeted to record lows, what many refer to as a frozen housing market. And the primary culprits are low inventory, high mortgage rates, and stubbornly high home prices that today have pushed most would-be homebuyers to the sidelines. However, the housing market could thaw very quickly should foreclosures continue to surge. Case in point, Redfin reports foreclosures have steadily risen as interest rates increased. And a new report from Adam reveals an 8% increase in foreclosure filings. In addition, REO numbers in several states have reached levels not seen since the great financial crisis and housing crash of 2008. The annual increase in foreclosure filings in February jumped 51% in South Carolina, 50% in Missouri, 46% in Pennsylvania, and 7% in Texas. Despite this surge in foreclosures, 28 states actually saw a reduction in foreclosure activity. That would indicate the regional impact of employment or underemployment. With that in mind, let's look today at the highest foreclosure rates for larger cities with a population over 200,000 residents. In February, there were 1,367 foreclosure starts in New York City, 998 in Houston, 808 in Los Angeles, 792 in Chicago, and 777 in Miami. Keep in mind the long-term ripple effects that are continuing to be felt from the expiration of foreclosure and eviction moratoriums. The annual uptick in U.S. foreclosure activity hints at shifting dynamics within the housing market, said Rob Barber, CEO at Adam, in a press release about the report. These trends could signify evolving financial landscapes for homeowners, prompting adjustments in marketing strategies and lending practices, which basically really doesn't tell us anything. Yet, the underlying shifting dynamics are indeed the unemployment rate, interest rates, and economic conditions. More importantly, increased foreclosures, whether it be locally or nationwide, increases housing inventory and pushes home prices down. Now that would impact future potential reverse mortgage borrowers and those affected areas. But what about the economy? The news reports would leave us with the impression that all is well. But is it? Bloomberg Economics ran 1 million forecast simulations on the U.S. debt outlook. 88% of them show borrowing is on an unsustainable path. Bloomberg reports the Congressional Budget Office's latest projections show the U.S. federal government debt is on a path from 97% of GDP last year to 116% by 2034, higher even than World War II. And that should come as no surprise with spendthrift lawmakers in both parties in Washington, D.C., spending away the future of coming generations. The trick is we enjoy the benefits of deficit spending in the short term, and Congress knows this, as it keeps them in good standing with voters. However, as debt levels continue to rise, creditors and those buying U.S. Treasuries will begin demanding higher returns to offset the risk. Reduced demand for U.S. Treasuries would push interest rates up even further, slow the economy, and lessen the value of the dollar. All of these factors will contribute to further downward pressure on home values. Now, should the government continue to print money to mitigate the impacts of a burgeoning debt and then inflation, well, we would see it accelerate again. In conclusion, the bottom line is home prices are likely to soften in several metropolitan areas across the country. But A nationwide housing depression is highly unlikely, barring any unforeseen black swan event. In the meantime, what we can do is to be observant of national and local economic trends and continue to search for older homeowners who could use some financial relief that a reverse mortgage could provide. Now, before we go, I want to let you know that we have now added playlists to our YouTube channel so you can quickly find videos for this or any other of our shows. Now, before you stop this video, please take a minute and share today's episode on your LinkedIn feed, and don't forget to subscribe to our YouTube channel so you never miss an upcoming episode. And each and every week, as I tell you, if you're new to the show, we have the nation's only weekly podcast with reverse mortgage news. That is Heckam World Weekly. You can find us on Apple Music, Spotify, Podbean, and we do have a video companion edition as well on Heckam World and YouTube. Thanks again for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find here at Heckam World.